And I'm Judge Sarah Hosey, and with me today on my panel is Judge John Johnson, excuse me, and Judge Veronica Long. With us today is hearing reporter Christina Rodriguez. Just a reminder to speak clearly and loudly in our microphones. We are moving to arguments today, starting with appellant. Is that right, Mr. Antolin? Okay, and then we'll go to Franchise Tax Board. Is that right, Mr. Havens?
Yes, Judge.
Everyone has their materials?
Yes.
Okay, great. And then we'll move back for final rebuttal closing statements from appellants. I'm gonna see how things go for a break. Hopefully, we can take one about an hour and a half in, depending how things go. I don't want to interrupt in the middle of anything, so we will see how that goes. Are there any questions I can answer before we go on the record?
Will you be asking questions during the argument?
Oh, yes, I'm sorry. After each presentation, we'll have time for questions, and then we'll do another final round at the end after rebuttal, if
Perfect.
that works for everybody.
Sure.
Okay. Any other questions before we begin?
No questions.
No.
Okay, great. We are now back on the record in the consolidated appeals of Western Distributing Company and its non-resident shareholders. It's March 18th, 2026. At approximately 9 a.m. We are now moving to appellants for oral arguments. Mr. Antolin, are you ready?
Yes, Your Honor.
Please begin.
Thank you. We have a PowerPoint slides, and we're ready to present those. Thank you. So as we discussed yesterday, there are 6 questions. The primary question being whether the beverage distribution business and the transportation business operated as unitary business. If they did not, everything else, all the other issues fall away. And so we're going to focus primarily on that and touch on the other issues in the alternative. So whether or not the transportation business and the beverage business operated on a unitary business is very clear that there has been ample testimony to establish the separate nature of those operations. First, and very importantly, those two divisions operated in very, very different types of businesses. One was buying and selling beverages, and the other was providing an interstate transportation service. Two, each of those businesses operated with very separate day-to-day and strategic policy-making management. 3, they operated with very separate operations. The testimony established that the two divisions had separate employees, separate staffing, separate management, separate facilities, separate equipment, separate customers, separate bookkeeping, separate accounting, all of that. 4, there was no vertical integration between the businesses. Now, the FTB argues that there were signs of vertical integration, and I will touch on this in a bit, but the evidence in the testimony is very clear that, in fact, in 2010, the year at issue, there was no vertical integration between any of the divisions. Finally, there were no meaningful centralized functions here, and I'll discuss each of those functions. Now, to be sure, there were modest shared functions. For example, there was a corporate accounting group that was used to prepare corporate level financial statements and tax returns. There was shared insurance purchasing, single checking account, and running a payroll, and we'll touch on those as well. But those connections are not the kind of integration by themselves that you'd expect to see in a unitary business, and certainly not the kind of connections that the courts have relied on to find a unitary business, and we'll go through that as well. So when we review alleged unitary connections, the connections that the FTB relies on, I want you to keep in mind what it is that the FTB is not saying. They are not saying that beverages and transportation had synergies and that benefited both. They're not saying, for example, that they shared a warehouse or that they shared equipment or that they shared management so that that would enable both divisions to benefit from synergies between them. They're not saying that there was this type of integration at the operational level. They are not saying that. What they are saying is, oh, well, look, there's some insurance and there's a corporate accounting department, there was payroll. But as we know, and what the Board of Equalization has said in 20th Century Fox, to demonstrate the existence of a unitary business, it is necessary to do more than simply list circumstances which are labeled unitary factors. You have to show how those factors actually lead to synergies and benefits that result in these separate businesses operating as one business or as a unit. And that is where the FTB's argument fails. It's merely listing factors. It is not saying how did transportation and beverages operate as one unit? How did they benefit from these alleged connections? So now what I'd like to do is kind of break down each of the arguments from the FTB's briefing. So on page 15 of the brief, the FTB argues there was complete overlap between WDC's board of directors and executive officers and the management of the divisions. First, that's not true. It is not true that there was complete overlap between the management of the divisions. Now, it is true, WDC is a single corporation. As a single corporation, it will have a single board of directors and a single set of officers. But that is typical of every corporation that has divisions that operate separately or that operate as a unitary business. That is not a material unitary connection. It is not true that there was complete overlap in the management of the divisions. The testimony is undisputed that each division had its own separate managers in place, and those managers, because of the policies set by Mr. Gaines as a CEO, had the authority and the direction to operate autonomously, to operate independently of all of the other divisions. So it is not true that there was complete overlap in the management of the divisions. What there was at the corporate level was merely high-level oversight, as you would expect in any corporate setting, whether unitary or not. Keep in mind, during 2010, the CEO, Mr. Gaines, was actively acting as a professional NHR car race driver and on the road for 40-plus weeks of the year. He had a full career doing something separate from the operations of these businesses. It was not practical for him to be involved in the day-to-day operations, and nor was he. It wasn't consistent with what he envisioned for a business, for each of these divisions to operate as independent businesses. To be sure, he checked in. He wanted to see how they were performing financially. He had Chris Boggs also, the CFO, in place to check in and see how the divisions were performing financially. But that is typical of any unitary business. The day-to-day operations and the strategy decisions were made at the division management level. As we know from the Court of Appeal, in Tenneco, managerial links, including interlocking boards of directors and frequent communications between upper management levels, are characteristic of any parent, and its wholly owned subsidiary, and without more, are not relevant to the issue of unity. Next, on page 8 of the respondent's brief, the FTB just lists these alleged centralized functions. The FTB writes, WDC provided centralized accounting, purchasing, human resources, and dispersing functions for its divisions, and employed a single checking account. Let's look at each one of those in detail. There was no centralized accounting. The books for each division were maintained by each division. The testimony on that is undisputed. And also we know from Tenneco that centralized accounting without more is not a significant unitary factor, and the FTB itself in its own audit technique manual states common tax return preparation and common financial statement preparation will not carry any weight in a unitary context. So here we know that what the central office did in the corporate accounting group was gather the financial information from the separate divisions and then combine that into a corporate level financial statement, and also gather that information for the preparation of state and federal tax returns by their accounting firm. So it really is more of a, you could think of the corporate accounting group as more of a clearinghouse. They are the ones pulling together the financial information from the operating divisions, and those operating divisions kept their own books, used their own separate accounting software to keep their books, and all of that information then had to be rolled up to the corporate office so that the corporate office could prepare financial statements and tax returns. That is not the type of unitary connection that you would expect, that courts have ever relied on, because in this context, a corporation, single corporation, is obligated, for example, to prepare tax returns. It has to gather that information from the divisions. It has no choice. The divisions cannot prepare their own tax returns. The FTB has also argued that there was that there was in effect centralized purchasing. In fact, there was no centralized purchasing. The testimony, undisputed, is that each manager in each division made its own purchasing decisions. And as Mr. Guadagni testified yesterday, the divisions would create a purchase order on their own without approval from the corporate office. They would send that purchase order to the vendor for fulfilling. The vendor would fulfill that order, send an invoice, and the divisions would receive that invoice and connect that invoice to the purchase order, receive the order, make sure that all of the inventory that was purchased actually shows up on the dock. So, reconcile to see if there are any differences. And once all of that process is completed at the division level, that paperwork is packaged up, signed off to be paid, approved by the division management as ready to be paid, and then that little package, and encoded, so for example, cost of goods sold or taxes or however, it needs to be coded for financial accounting and tax return purposes, and then that little package is sent to the corporate accounting department to pay. So the corporate accounting department really does literally nothing except write the check in that situation, and it has the coding, so it already knows how that expense should be coded in for corporate financial statement purposes and for corporate tax return reporting purposes. As to insurance, it is true that in this year, the insurance was purchased centrally at the corporate level, but you have to keep in mind that the insurance, that 2-page document in the exhibits, is not the policy. It appears to be a summary of the policy, but the actual policy would have had riders for each of the businesses, and separate underwriting for each of those businesses. And then, of course, the expense for insurance would have been allocated to each of the businesses. And as Mr. Gaines testified yesterday, in some cases, the businesses, each division could contact the broker and see if they could get a better rate. They were not precluded from doing so. But in the end, the focus on insurance, in our view, is a minor connection. It is common in the corporate setting, whether there is a unitary business or not a unitary business. For example, the Court of Appeal in Chase Brass said, but Connecticut does some minor purchasing for Chase. In some instances, insurance was purchased for 2 or more companies. That is a minor connection, according to the Court of Appeal in Chase Brass. And recall, in Chase Brass, the Court of Appeal found one group to be unitary and another group to be non-unitary. And in A.M. Castle, the Court of Appeal said, although the companies had some overlapping insurance, there was no significant integration between the day-to-day administrative operations. Again, reflecting that insurance is a minor connection in the overall unitary analysis, and it certainly is minor in this case. What you don't see with respect to centralized purchasing is centralized purchasing with respect to the core operations of the business. You don't see centralized purchasing for inventory or for product. You don't see centralized purchasing for equipment used by the businesses. And you don't see, for example, centralized purchasing for accounting software, because each company had their own separate software. And you don't see centralized, in a way it's purchasing, centralized hiring of employees. All of that is separate, and the expenses are incurred separately. Next, the FTB says that there was a centralized human resource department. And again, that is an overstatement. Here, the testimony is undisputed as to who manages the employees, who decides who to hire, who to fire, who decides how much to pay the employees, who decides the schedule, the work schedules, the vacation schedules, all of that. All of that is set at the management, by the managers of the divisions, not by the parent corporate office. Now, there was a centralized payroll processing activity at the corporate level, but as we know, it's similar to purchases in that the division level management sets the wages, sets the hours worked, tracks the hours worked by the individual employees, and then gathers that information, determines how much the payroll should be for employees, and then sends that information to the corporate office so that the corporate office has the right numbers to enter into the payroll processing service. ADP, I believe, is what they used during this period. As to health insurance and other benefits, those were centralized out of the corporate office, but in our view, in a corporate setting, it is typical for a corporation to have a single health insurance plan that covers the corporation, or to have employee benefits that cover the corporation as well and all of its employees. In Tenneco, the Court of Appeal said Tenneco lacked substantial centralized departments, even though we know in Tenneco there was extensive employee benefits and health insurance and all of that that was centralized in the corporate office in Tenneco. Still, in that case, the Court of Appeal found that there were in that case called the excluded subsidiaries, were not engaged in unitary business with the parent. Now, there was some discussion yesterday about onboarding, and Mr. Gaines and Mr. Guadagni said that employees were onboarded at the division level, and that is correct. Because of the very different operations of each business, onboarding had to be done at the division level so the employees knew kind of what the policies were, their expected work schedules, when they could take vacations, all of that, the day-to-day. But then also, Mr. Boggs testified in his declaration that there was some onboarding at the corporate level, and that would have been to just make sure that people get entered into the payroll system. You need to get their W-9 and that kind of thing, make sure they're signed up for health insurance and those types of things. Let's turn to the single checking account. So the writing of checks, so there's the writing of checks, there's the single checking account, and then there's the line of credit. Let's talk about all of those. The FTB argues that the divisions did not have independent capital, and that is not correct. We know from testimony that is undisputed that the divisions had control over their purchasing. When they needed to buy something or needed to hire additional employees, they had the authority to do so. Merely having the payment come out of a central checking account does not mean that the purchasing decisions were not made at the division level. In fact, the purchasing decisions were not centralized in any way. So in this case, as I mentioned earlier, when the divisions made purchases, they packaged up the purchase order, the invoice, they confirmed that everything purchased actually arrives, and then when that is all confirmed, all that documentation is packaged up, signed off, the expenses are coded as cost of goods sold, for example, or taxes, and then all of that is sent to the corporate office for the writing of the check. The nominal benefit of having the corporate office print the check and sign it is really almost no benefit to the operating divisions. And why is that? Because the operating divisions had their own bookkeepers. They could have easily printed that check as well and signed it. That takes 1 minute, if even that. And so the notion that having the central office do that confers some type of significant or material benefit for unitary analysis is not true. I also want to note that when the corporate office printed checks, they printed the division's name on the checks. The checks were not coming from the corporate parent, they were coming from the operating divisions. And the reason for that is important because to the world, to the vendors of the various operating divisions, they knew the operating division. They didn't know the corporate office or the corporate parent. So they needed to understand that these payments, these checks, were coming from the company or the business that they were dealing with. And that's an important point. The single checking account, Mr. Gaines testified yesterday that really the reason for having that is to be able to monitor cash and expenses coming in and out of the company. It's important, especially for a smaller family-owned business, that they be able to keep an eye on things because, as Mr. Gaines pointed out, in some instances there could be fraud or embezzlement, and they need to be tracking that very carefully. And also I want to point out in Mr. Boggs's declaration, in some cases, in a pinch, if a division really needed to write a check quickly, they had the ability to do that. They had blank checks. It did not happen often, but if that occasion ever arose, the divisions were empowered to write their own checks if they had to. It's not the normal course, but they also had that ability, and they had the blank checks to do that. I'd like to talk briefly about the line of credit. As Mr. Gaines testified yesterday, the line of credit related only to the beverage distribution business. It did not benefit the other operating divisions, did not benefit transportation. So as the Court of Appeal in Tenneco said, business strategy and activities, including cash management, which is really what we have here, constituted the kind of behavior that one would expect to find in any parent subsidiary or parent division relationship. Next, I'd like to address the FTB's argument that contribution and dependency existed between the beverage and transportation segments due to vertically integrated operations within WDC's wholesale beverage chain. And that's on respondent's brief at page 17. As the testimony in the declarations and the testimony we heard yesterday, it is undisputed that these were not vertically integrated businesses. What do we know? We know that Mr. Gaines in the 1970s had the idea that if they owned their own interstate trucks, they could go pick up inventory and bring that inventory back to the warehouse in Colorado for the beverage distribution business. That's what we know. We know that that occurred, that idea originated, and the purchase of the original trucks occurred in the 1970s. But what we also know is that it didn't work out. It is, when you think about it in a very simple way, sending an empty interstate 18-wheeler truck to Florida to pick up rum to bring back to Colorado, or sending an empty truck to Kentucky to pick up bourbon to drive back to Colorado doesn't make sense, because you are incurring the expense both ways, going out on an empty truck and coming back with a full truck. That makes no sense in an interstate trucking operation. And Mr. Gaines realized that and decided, well, what does make sense is to use these trucks to provide interstate trucking services to everyone, and that's what he did. He stated yesterday that by the late 80s or the 90s, the trucking business and the beverage distribution business had become completely separate. And certainly by 2010, the operations of those two divisions were completely separate. And we know that because the volume was less than 1% of beverage distribution's inventory that was received on Western distributing transportation trucks. We also know that because whenever the beverage distribution division decided to use the transportation division trucks for transportation services, they charge an arm's length price. So there was absolutely no benefit to that relationship. And how did the bulk of the beverage distribution business's inventory arrive at the warehouse in Colorado? Mr. Guadagni testified that for almost all purchases of inventory, it is the manufacturer or the brewer, Miller Brewing, for example, that arranges the shipping. And they demand that. They do not let the distribution wholesalers arrange shipping. And so the distribution business had no ability to create this vertically integrated business. And in fact, there was not one. So I'd like to sum up our unitary position. As I started saying that these were different businesses, They had separate management at the day-to-day and the policy level. They had separate operations. There is no vertical integration and no meaningful centralized functions. Merely listing those functions is not enough. What FTB must show for there to be a unitary business is that the connections create synergies or unquantifiable flows of value between the beverage distribution business and the transportation business. We don't see that. We don't see any evidence that there was these synergies or unquantifiable flows of value between the two operating divisions. What we see is completely insubstantial number of intercompany transactions that were all charged on an arm's length basis and were bid out like they do for all of their transportation services when they need them. That derives no unquantifiable flows of value from one division to the other. That's as if they're dealing with a third-party customer. We have a very modest amount of purchasing on insurance, but again, there's no evidence that somehow that creates these unquantifiable flows of value between the two, or if there are any, they're modest, extremely modest in the big picture of the operations of the two corporations. What the FTB has also suggested is that by having Mr. Gaines sign declarations that relate to federal court litigation, that somehow evidences a unitary business. But again, there's no evidence that, in fact, the beverage distribution business and the transportation business were truly integrated. The statements on those declarations related to motions to remove actions in state court to federal court. And as I explained yesterday, one way to get into federal court is through diversity jurisdiction. And when a corporation is a party, the corporation is viewed to be a citizen of the state where it is incorporated or where its principal place of business is located. And for the purposes of diversity jurisdiction, the principal place of business is, by default, the headquarters office. That is the sole purpose for those declarations, is not to establish that there was or was not a unitary business. And our view is that the FTB's reliance on those declarations is just overstating what the true purpose of those declarations purposes were. And finally, as to the declarations that were signed decade or more after the year at issue, we would say that those have no relevance to the case, and to the declaration that was signed 2 years before the years at issue, or the year at issue, it also is not relevant because it precedes the year at issue. The FTB also yesterday during cross-examination asked Mr. Gaines about whether he signed documents related to the sale of the beverage distribution business. And that is true. He did sign those documents. But again, that is not sign of a unitary business or centralized management between the beverage company and the transportation company. What does it mean when Mr. Gaines signs the sale agreement? Well, the sale agreement is between two legal entities, the buyer and Western Distributing Company. It has to be signed by an officer of Western Distributing Company to be valid, and that is the sole purpose for that. That is not to say that he was signing that in his capacity as an active manager of the operations of the beverage business or of the transportation business or of any of the businesses. He's signing that in his capacity as a legal officer of the corporation, and really had to sign that. He had no choice. And then finally, the context of the sale of the beverage distribution rights. The decision to sell the beverage distribution rights also does not evidence centralized management by the corporate office. And the reason for that is they did not have a choice to sell those beverage distribution rights. When Miller and Coors combined, the result after that combination was that you had a Miller distributor, which was Western Distributing or beverages, and you had a Coors distributor operating in the same location, and that's untenable. So the combined Miller-Coors told Western Distributing, you have to sell. They had no choice. They were compelled to sell, and they were chosen as the party not to be the ongoing distribution company for that combined group. So they did not make that decision. That was imposed on them. So the various connections that FTB relies on are not the type of connections that courts have found create a unitary business. On the one hand, when you have diverse businesses, you have cases like Dental Insurance or Mole Richardson. And in those cases, you have some centralized functions. You have centralized accounting and even insurance. But the courts do not conclude that those very diverse businesses were unitary based on that. In those cases, what the courts relied on was the very, very strong centralized management in both of those cases. So when courts find that there is a unitary business in the context of diverse businesses, they do look at, was there centralized accounting or other functions such as insurance, but what they really hone in on is strong, strong centralized management, because that is how you can have diverse businesses become one single unitary business. And so, for example, you had in the dental insurance case, you had the management of the dental insurance company very involved in the agriculture company or business, also owned by the taxpayer. So far so as deciding what crops to grow, what land to buy, what land to sell, very, very involved. That is not present here. This case is much more like the Tenneco case. In Tenneco, you had an integrated oil business, which was a unitary business, but you also had a diverse set of businesses. You had shipbuilding, tractor building, packaging business. And in Tenneco, the question was, well, are those other businesses, the non-oil businesses or the diverse businesses, are they part of the oil unitary group? Like in our case, in Tenneco, there was a very, very strong corporate policy for independent management of the various businesses, which we have here. And in that case, the court concluded that the separate businesses, the shipbuilding, the tractor building, the packaging businesses, were not part of the unitary oil business, partly because of the very strong policy at the very highest level in the corporation that the businesses should operate separately and independently. We have the same policy in our case. The court found that the shipbuilding, tractor, and packaging businesses were all non-unitary, notwithstanding that there was some centralized connection from the corporate headquarters. For example, at the corporate parent in Tenneco had to approve all purchases exceeding $100,000. They had to approve all hirings of anyone whose salary exceeded $25,000. There was a centralized plan for evaluating professional employees. There were centralized benefits, employee benefit plans, thrift plans, retirement plans. There was a centralized insurance department in Tenneco. Notwithstanding all of that, the Court of Appeal concluded that that the shipbuilding, tractor building, packaging businesses were not part of the same unitary business. That is the controlling analysis in our case. So the bottom line, what do we have here? We have a beverage company that was licensed and legally authorized to operate and sell beer only in Colorado. The FTB wants to tax a portion of the gain from the sale of the distribution rights from that business. The only way it can do that is by establishing a unitary business with transportation. As we have shown, and as the testimony has established, the alleged connections are too thin to establish a unitary business with California. And when you think about those connections, let's assume that those connections had some weight, and we should consider them. Well, all of those connections occurred in Colorado. The corporate accounting department's in Colorado. The insurance purchasing decisions are in Colorado. So how is California contributing to the quote alleged unitary business? It is not. The only connection activity in California is trucks are coming into California on very rare occasion, and this is very rare, less than 1%. They are picking up inventory in California and driving it back out, but at market rates. So there really is no benefit that the activities in California create some type of synergy, unquantifiable flow of value that benefits the beverage activity in Colorado. So in sum, we think that the connections that the FTB relies on are too thin to create a unitary business. There really is not one. If the board or the panel were to conclude so, it would expand beyond what the current case law defines as a unitary business, and the panel should certainly not go that far, because no case under these facts has found, or similar facts, I know that they're all fact specific, but no case has found a unitary business on such thin facts where we don't really have any strong centralized management or strong integration of the operations of the businesses. So I'd like to turn to the other issues, which are all in the alternative. So assuming, for the sake of argument, that there is a unitary business, well, our first argument on 17951-4 and the flow-through of the gains to the shareholders, our view on that is that because there is not a unitary business, that gain, therefore, is not apportionable business income and cannot flow through to the shareholders under 17951-4. Now, turning to the arguments that are in the alternative. So the first argument is the application of the special trucking regulation under 25137-11, and it is there. I'm not going to read it for you, but I'd like to focus on just a few parts of that regulation in this next slide. So first, the regulation says the first step is to determine what portion of the trucking company's income constitutes business income. We note it says the trucking company's income constitutes business income, and then that business income is apportioned to this state pursuant to the property, payroll, and apportionment factors set forth in this regulation. So the second point is that when we have trucking company business income, that income must be apportioned as set forth in 25137-11, and then non-trucking company income is not apportioned under section 25137-11. It is that simple. We have one trucking company here. A trucking company is defined in the regulation as a motor carrier transporting property of others for compensation. And we only have one business that is doing that. Now, we have noted that WDC, the corporation, is registered with the U.S. Department of Transportation as a motor carrier, but if you were to look up its registration on the U.S. DOT website, you will see that it is registered it's doing business as activity or entity that is registered. And the doing business as entity is the Transportation Division. No other division in WDC is technically registered with the U.S. Department of Transportation. But I'd like to also point out that the definition of a trucking company does not turn on registration with the U.S. DOT. The definition of a trucking company in Regulation 25-137-11 is simply a motor carrier transporting property of others for compensation. And here we have only a single motor carrier that is transferring the property of others for compensation, and that is the transportation entity. The FTB's position seeks to expand the scope of 25-137-11 to groups, and we're assuming there's a unitary group for purposes of this argument, although we have already established that there is not a unitary group. But if we assume that there is a unitary group, the FTB's position is that 25-137 should apply to an entire unitary group if one part of it is a trucking company as defined in the regulation. But the problem with that argument is that the regulation does not say that. It very clearly says that only trucking company income is apportioned under the rules in 25-137, so that only the income of the Transportation Division should be subject to the rules in 25-137. And if you do that, then when you turn to assuming there's a unitary group, the gain from the sale of beverages would not be apportioned under the rules in 25-137. It would be apportioned under the standard rules, and it has no factors in California. It has no sales, no payroll, no property in California. The next argument we make is that even if you were to accept that there is a unitary business, and if you accept that 25-137-11 applies, that the resulting apportionment percentage in California is skewed. And we can see that here. Look at the FTB's apportionment percentage for 2010. It is 6.3257. It is an outlier when you look at the apportionment percentage for the prior years, 09, 08, 07, 06. And why is that? The reason it is so far off from the prior years is because the sale occurred on January 11, 2010, so at the very beginning of the year. And because of that, the apportionment factors that result in 2010 exclude essentially all of the distribution businesses' activities because it was no longer owned. You don't have the sales of the distribution business. You don't have the payroll of the distribution business. You don't have the property of the distribution business. And that skews the apportionment percentage in 2010 so that essentially you are apportioning the gain from the sale of the distribution business by the transportation company's factors and not the combined distribution business factors and transportation business factors. And our view is that that is, does not fairly reflect the activities of this alleged unitary business in California. As you can see, it overstates the level of activity in California. And there are two reasonable ways to cure that distortion. One way is to, well, let's look at the period during 2010 when the companies were still operating together. And we get a apportionment percentage of 2.9%. Another reasonable way to cure that distortion is to look at the prior year. And you get a more reasonable, balanced result that reflects the activities of the distribution business operating with the transportation business. Next, I'd like to touch on penalties and interest. So the penalties should be abated. And why is that? So what we know from the U.S. Supreme Court in Boyle is when an accountant or attorney advises a taxpayer on a matter of tax law, such as whether a liability exists, it is reasonable for the taxpayer to rely on that advice. So in this case, we have a complicated issue, I'll admit that. When Western Distributing Corp sold the beverage distribution business, or the licenses that they had, the rights, the distribution rights, the question then is a portion of that gain subject to tax in California or not? Should it be apportioned? Is there a unitary business or is there not a unitary business? If there is a unitary business, what is the proper apportionment and how do you compute that? How do you apply the trucking regulation to this diverse alleged unitary business? Those are all complicated tax issues. As Mr. Gaines testified yesterday, none of the shareholders of WDC are tax professionals. They rely on WDC's tax expertise and really the tax expertise of their accounting firm to determine the proper sourcing for that gain. That is reasonable to do here. It would not have been reasonable not to follow the sourcing recommendation by the accounting firm that prepared the returns. Because of that, under the standard in Boyle, the penalties imposed on the individual shareholders, there was no penalty imposed on WDC. The penalties imposed on the individual shareholders should be abated. These are complicated tax issues. They rely on tax professionals to tell them how to report that. It gets reported on their K-1s. They're entitled to rely on the reporting in those K-1s. There's no reason to think that those K-1s weren't looked at and analyzed by professionals. Because of all of that, the penalty should be abated. Finally, interest should be abated. The FTB has agreed to abate 11 months of interest. We believe that interest for any period exceeding 36 months should be abated. When you calculate the time from the date of the protest to the determination letter, 7 years, 5 months had elapsed. FTB's agreed to abate 11 of those months. We think anything in excess of 36 months should properly be abated because of delay by the FTB. And there was lots of delay caused by the FTB. There was a change in the protest hearing officer. There was delays in issuing the protest determination letter. But I think in any instance, 7 years, 5 months from the date of protest to the determination letter is excessive. And that is the reason that the interest in excess of 36 months should be abated. Finally, I'd like to just touch on the FTB's tax benefit rule arguments in their briefing. That's a new issue that was not raised in the protest or at audit. Under Mendelsohn, the FTB has the burden on that issue. We don't believe that they have met their burden to show that there has been any tax benefit in this case. What they have shown at most is that amortization deductions and Other loss or casualty deductions were claimed on returns, but that is not sufficient to show that there is a tax benefit. Under HV Management Corp., an appeal at the Board of Equalization, the board said, if the events which give rise to the loss in the prior year and the recovery in the current year do not constitute a single integrated transaction, the tax benefit rule has no application. We know by definition here there was not a single transaction. The FTB has said there were amortization deductions and other loss deductions. That is one thing. Here, the recovery, quote, alleged recovery, is the sale of the beverage distribution rights. Those are completely different transactions, so no basis for the application of the tax benefit rule. With that, I will conclude my argument.
Thank you, Mr. Antolin. I'm going to see if the panel has any questions for you at this time. I'm going to start with Judge Johnson. Any questions?
No questions at this time. Thank you.
All right. Judge Long, any questions?
Okay, there we go. I just want to ask one or two questions. When I was listening to your argument, there were a couple of mentions of things that I wanted to find out if we have them in the evidentiary record or if it's only in the argument. The first item, you said that the divisions printed checks, so that the parent company printed checks from the divisions with the names of the divisions on them. Do we have that in the evidentiary record?
That's in Mr. Boggs' declaration. I can't recall the exact number. I could get that for you.
That's all right. I'm happy to review the declaration.
It's a two-page declaration, I think, or 3 pages.
I'm
it's in
happy
there.
to look and confirm. I just wanted to make sure we have it in the record while we have witnesses present. And then my second question is related. You also said the divisions had blank checks. Would I also find that in the Boggs declaration?
Yes.
I see you're nodding. Thank you. That's all my questions. Thank you.
I'm going to save any questions until after rebuttal, just so all the arguments are out. I'm going to check in. I think now is maybe a good time for a quick break, and then we'll move to the Franchise Tax Board's main arguments. That will be a bigger chunk of time, and then we'll go to rebuttal and more questions from the panel if there are any. Any questions before we go on a break?
No questions?
Okay, well, it's 9:53. We'll take a 15-minute break, and we'll return at 10 after 10. We're now off the record. Okay, welcome back. We have the materials ready for the Franchise Tax Board's presentation. Okay, panel ready? Reviewers ready? All right. We are now back on the record. We are now moving to the oral arguments from Respondent Franchise Tax Board. Mr. Havens and team, are we ready to begin?
Yes, Judge. we are.
Please begin. Thank you.
Good morning. As previously stated, I'm Ken Havens for the Franchise Tax Board. When Western Distributing Company, or WDC, filed its California return for the taxable year ended December 31st, 2009, it reported that WDC was engaged in a beer, wine, and distilled alcoholic beverage wholesale business, and that WDC and its various divisions, to include its transportation and beverage divisions, were engaged in a diversified unitary business with no separate trader business. As WDC was engaged in a unitary trader business, WDC included income and expenses from its beer distribution operations and trucking operations as business income. WDC's beer distribution rights were identified as business assets of WDC's diversified unitary trader business, and WDC amortized and deducted beer distribution rights from its unitary gross income. However, when WDC sold those same distribution rights and related assets, just 11 days later, on January 11th of 2020, WDC claimed the distribution rights had lost their business character. WDC still reported that it was a beer, wine, and distilled alcoholic beverage wholesaler, and that its various divisions were engaged in a diversified unitary business. However, despite including income and expenses from the beer distribution operations and trucking operations, WDC claimed the gain on those previously reported business assets was non-business income. While WDC included the gain from its tax base, it included the gain in the sales factor denominator. Thus, WDC claimed the same item as allocable non-business income for the purposes of the income tax base and apportionable business gross receipts for the purposes of the sales factor. Clearly, WDC made an error on its originally reported 2010 return. The Franchise Tax Board's position is that WDC's error was in the characterization of its sale, and that WDC's sale of a previously reported business asset of a self-reported unitary trader business constituted business income. Pursuant to the application of the Standard Apportionment Formula under the Uniform Division of Income for Tax Purposes Act, or UDITPA, WDC is taxable on its apportioned gain from the sale of its beer distribution rights and the related assets, and WDC's non-resident shareholders are taxable on their distributive share of the apportioned gain. The appellants would have you believe that WDC's error was not in the characterization of the sale, but rather in WDC's representation that a unitary trader business existed at all. In contrast to its original filing for the year at issue and prior years, WDC has claimed at audit and protest, and now on appeal, that its self-reported unitary trader business in 2010 was a fiction, that WDC's contemporaneous representations to the contrary were untrue, or, in the alternative, WDC claims that even if its contemporaneous representations that it was engaged in a unitary trader business were correct, that the operation of law requires WDC's trucking division be treated as a separate trader business. Or, failing that contention, WDC claims that the standard apportionment formula reflecting WDC's actual business operations for the year at issue must be thrown out, and that unitary operations conducted over 5 business days in January must be used to apportion the sale of business assets that appreciated over years. Upon review of these claims, the Franchise Tax Board found that WDC's facts supported a finding of unity, and that WDC's assets were business assets of a unitary trader business. Thus, the FTB's assessment comports with the binding admission that WDC made on its original return, that WDC was engaged in a diversified unitary business, and imposes the tax consequences that logically follow from that determination. In the presentation that follows, I'll review why WDC's filings, contemporaneous documentary evidence, witness testimony, and WDC's facts confirm that a unitary relationship existed between WDC and its beverage and transportation divisions in 2010. I'll establish that WDC's standard UDITPA formula required the apportionment of WDC's trucking activities under California Code Regulations, Title 18, which I'll refer to as the CCR, at Section 25137-11, and the exclusion of WDC's substantial and occasional sale under CCR Section 25137, Subdivision C1A. I'll then establish why, as a result of this treatment, WDC and the non-resident appellants owed tax in the year at issue. Finally, as WDC's non-resident shareholders did not file returns and have not demonstrated reasonable cause, I'll address why the penalties assessed by the FTB should be sustained and why interest is due. The California Supreme Court has provided two tests in determining whether a unitary relationship exists: the three unities test and the dependency or contribution test. Both the three unities test and the dependency or contribution test have been ratified by the United States Supreme Court as part of the settled jurisprudence of the unitary business principle. The three unities test provides that unity exists if unity of ownership, unity of operation, and unity of use are present. WDC was unitary with Western Beverage Distributing of Colorado, or Western Beverage, its beverage distribution division, and Western Distributing Transportation Corporation, or Western Transportation, its transportation division, under the three unities test. Next slide, please. Under unity of ownership, ownership requires a bond of control or ownership between the unitary businesses. WDC was founded in 1933 by Vieri Gaines's grandfather as a family-owned Coors beer distributorship, and Vieri Gaines became CEO of WDC in 1977. In 1986, brothers Vieri and Carlo Gaines restructured WDC, bifurcating stock into voting and non-voting shares. For the years at issue, WDC's board of directors consisted of the siblings Vieri Gaines as president, Carlo Gaines as secretary, and Tekla Smith as director of the board. And the board members directly controlled 100% of WDC's voting stock, with Vieri Gaines controlling 84.12% of the voting stock. In addition to his position as secretary of the board, Carlo Gaines also held a VP sales role within WDC's beverage distribution division. Vieri Gaines' sons, Sterling Guadagni and Dino Guadagni, were shareholders of WDC and held management roles in the beverage distribution and trucking divisions, respectively. Vieri Gaines directed the formation of Western Distributing Transportation Corporation in 1977 and its dissolution and incorporation into WDC as a division in 1986. Vieri Gaines also personally established the Western Transportation and Western Beverage trade names. In 2010, Vieri Gaines, in his capacity as CEO and shareholder of WDC, and Carlo Gaines, in his role as a shareholder of WDC, were responsible for the disposition of Western Beverage's beer distribution rights, inventory, and related assets. For the taxable year ended 2010, Western Transportation and Western Beverage were wholly owned divisions of WDC without separate legal existence. Thus, unity of ownership existed between WDC and its divisions. Next slide, please. Unity of operations also existed between WDC and its beverage and transportation operations. Unity of operations refers to operational or staff functions. California appellate courts have looked to joint purchasing, joint accounting, joint finance, and joint human resources as indicative of operational unity, as these cost savings are shared among the divisions. In the appellate case of Dental Consultants versus Franchise Tax Board, the California Appellate Court found that a parent corporation's bookkeeping, accounting, check writing, legal, and insurance were core functions, creating obvious savings to the subsidiary and constituting unity of operations, even though the businesses were ostensibly managed by a professional management company and engaged in different lines of businesses. In that case, the insurance management hired professional managers to manage their farming operations. Similarly, in the appellate decision of Mole Richardson versus Franchise Tax Board, the court determined that centralization of operational activities from a parent and subsidiary, including accounting, purchasing, advertising, and maintenance of personnel records, processing of payroll, and expense payments, supported a finding of business unity. In this case, WDC engaged in joint purchasing, engaging a single insurance policy to cover WDC and all of its divisions, securing savings that accrued to all divisions. WDC operated centralized human resource functions across all WDC divisions, including onboarding new employees of WDC divisions, providing employment health insurance and benefits for WDC divisions, administration of a common performance incentive program for employees of WDC divisions. WDC's CEO testified that he acted as the EEOC officer for WDC and all of its divisions and engaged in litigation on behalf of WDC and its divisions. WDC's CEO further testified that WDC's human resource functions also included the promulgation of an employee handbook, which provided policies applicable to employees of all divisions. WDC's also administered a centralized accounting department with centralized dispersing functions for all divisions, overseen principally by WDC's CEO, Vieri Gaines, and WDC's CFO. WDC's headquarters handled payroll for employees of divisions, and WDC employed a single checking account into which all divisional income was deposited and from which all expenses were paid, removing the need for any intercompany finance agreements as all finances were managed and commingled in a single account. A sample statement provided by the appellants show that WDC's CEO personally signed 94% of all checks issued from WDC's checking account, covering operational expenses of WDC, Western Transportation, and Western Beverage. WDC also employed a line of credit secured by beverage assets that was mingled in with general checking account funds, and the interest of which was paid by WDC. In addition to the daily operational functions like payroll and dispersing, WDC's accounting department was responsible, according to Chris Boggs, for WDC's financial statements and tax returns encompassing WDC divisions, preparing profit and loss statements for all WDC divisions, and provided managerial accounting and financial data to inform WDC management and division management. In labor litigation involving the transportation divisions in 2021 and again in 2025, WDC's CEO's affidavits stated that management and administrative functions were conducted at WDC's headquarters in Denver, including, as proven in this case, human resources, finance, treasury, payroll, and safety. These are the functions identified by the FTB and supported by its exhibit for the years at issue. A single bank account for all operations and a joint line of credit, in addition to the centralized dispersing, purchasing, human resources, and accounting functions, is indicative of operational unity as it provides savings to all members of the combined group. In addition to these joint operational elements, operational unity existed between the beverage and transportation segments due to vertically integrated operations within WDC's wholesale beverage supply chain and asset management structure. Western Transportation was created to provide refrigerated long-haul capabilities for beverage operations and continues to provide beer freight delivery of Coors product throughout the United States. Sample invoices show that Western Transportation carried beverage inventory for Western Beverage and Western importers, fulfilling this vertical functionality. A captive transportation company provided WDC's beverage distribution operations with a dedicated long-haul solution for freight and provided throughput to WDC's Western Transportation division. Similarly, Western Transportation offered towing services to all WDC divisions, and WDC's in-house maintenance shop serviced assets of both the beverage and trucking divisions. In total, the centralized purchasing, accounting, human resources, finance, legal, and dispersing, coupled with the vertical integration of operations, are proof that unity of operations existed between WDC and its beverage and transportation divisions. Unity of use also existed between WDC and its beverage and transportation divisions. Unity of use refers to executive deployment and operational systems. WDC was a family-owned business. Regarding executive deployment, Vieri Gaines acted as CEO of WDC since 1977, was president of WDC's board, and owned 84.12% of WDC's voting stock. Vieri Gaines' brother, Carlo Gaines, was an executive VP of WDC and a sales manager within the beverage distribution division, secretary of the board of directors, and owned 8.4% of the voting stock. Vieri Gaines' sons were shareholders of WDC and managers of the beverage distribution and trucking operations. Vieri Gaines' affidavit states that trucking operations in support of WDC's wholesale beverage business began the year that he became CEO, and Vieri Gaines testified that he identified the value of long-haul trucking and backhauling on beverage loads as a vertical of WDC's operations. Vieri Gaines discontinued the separate existence of Western Transportation in 1986, merging Western Transportation and independent beverage operations into WDC, making WDC an S corporation under his control. Vieri Gaines personally established the Western Transportation trade name in 1987, and the Western Beverage trade name in 2001. In addition to establishing the divisions, Vieri Gaines oversaw common operational systems. Next slide, please. WDC employed a single checking account into which all divisional income was deposited and from which divisional expenses were paid, removing the need for any formal intercompany financing agreement. Vieri Gaines personally signed 94% of the checks issued from the checking account, covering operational expenses for WDC, Western Transportation, and Western Beverage. WDC's CEO testified that WDC held yearly planning meetings to establish budgets for divisions and approved WDC, or an approval from WDC executives was required for large purchases, even if made in the regular course of the division's business. Vieri Gaines reviewed dispersing not just of high-level expenses, but all operational expenses, as evidenced by his signature on divisional checks for as little as $2.25. This systematic level of involvement in day-to-day dispersing and review of day-to-day dispersing is a far cry from the high-level oversight any investor would provide an investment. WDC also employed a line of credit upon which it paid interest, secured by beverage assets that were commingled with checking account funds, and Vieri Gaines and Chris Boggs directed an accounting system wherein all revenue and all expenses were routed to WDC's checking account. Divisions relied on the WDC's central account for operational capital and cash. Division managers were required to consult Boggs and Vieri Gaines for large expenditures, even if made in the regular course of business, demonstrating the financial reliance that existed between the divisions. Vieri Gaines testified that he performed human resource and legal functions for all divisions, acting as WDC's EEOC representative and engaging with employment litigation proceedings on behalf of the divisions. In this role, and as CEO of WDC, Vieri Gaines signed a consent decree settling 58 employee actions on behalf of WDC and its divisions. WDC's CEO testified that WDC promulgated policies in an employee handbook, that employees were required to sign acknowledgement of such policies as part of WDC's centralized onboarding process. WDC offered employee discounts, allowing WDC division employees discounted automotive repair services at its in-house automotive repair shop and discounted alcoholic beverages from the beverage division. Moreover, in labor litigation involving the transportation division in 2021 and again in 2025, WDC's CEO submitted an affidavit stating that operational, executive, administrative, and policy-making decisions were conducted at WDC's headquarters in Denver. In 2010, Vieri Gaines, in his capacity as CEO of WDC, sold the beverage distribution rights that formed the core of WDC's beverage division, evidencing WDC's absolute control over the divisional business and assets. As WDC's president served as CEO, and WDC's secretary served as an executive vice president and division manager, and shareholders served as division managers, significant overlap existed between the board of directors, executive officers, and division management. The control exhibited by Vieri Gaines in his dual roles as president and CEO of WDC, and the systems of operation and management implemented at WDC constituted unity of use. WDC was also engaged in a unitary business when applying the contribution or dependency test. The hallmarks of contribution or dependency is whether the operation of the business in the state is dependent upon and contributes to the business without the state. As previously discussed, the divisions were entirely reliant on centralized financing and centralized functions for day-to-day operations, to include the trucking division's California operations and the beverage division's Colorado operations. The divisions contributed all income to the joint account and relied upon WDC to provide centralized dispersing, onboarding, payroll, and benefits. Thus, WDC's self-reported California trucking operations were dependent upon and contributed to the larger business. In addition to the dependence upon centralized function, contribution and dependency existed between the beverage and transportation segments due to vertically integrated operations within WDC's wholesale beverage supply chain and maintenance structure. Western Transportation was created to provide long-haul capabilities for refrigerated beverage operations, and sample invoices show that Western Transportation carried beverage inventory for Western Beverage and Western importers from California, fulfilling this vertical functionality. Moreover, Western Transportation offered towing services to all divisions, and WDC's in-house maintenance shop serviced assets of both the beverage and trucking divisions. Such an arrangement are evidence of contribution independence not just between the divisions, but with the unitary business as a whole. Appellant has argued, in general terms, that there was no flow of value between the businesses due to the interdivision transactions being conducted at arm's length. However, as demonstrated in cases such as AM Castle and Exxon Corp versus the Department of Revenue, flow of value may still exist when intercompany transactions are made at a market rate. Specifically, in Exxon, wholesale purchases and wholesale movement of capital was done by the Exxon Corporation. Despite the fact that these were done at market rate, unity and particularly vertically integrated operations were found to still exist. Next slide, please. The United States Supreme Court, in the case of Maranello versus United States, provided that, and I quote, "Our tax structure is based on a system of self-reporting, and the government depends upon the good faith and integrity of each potential taxpayer to disclose honestly all information relevant to tax liability," end quote. The OTA, in the precedential opinion in the appeal of Johnson, provided that a taxpayer's statements made on a signed tax return constitute binding admissions, and further provided that cogent evidence is required to prove that such statements are incorrect. The FTB's determination is presumed correct, and the taxpayer has the burden of proving error. Furthermore, in the absence of credible, competent, and relevant evidence showing that the FTB's determination is incorrect, it must be upheld. Next slide, please. Were there any creditability in appellant's various claims, either that its sales were non-business, as originally reported, or that its beverage operations were non-unitary or part of a separate trade or business under any of appellant's theories, deductions taken in years prior to and including 2010 would be subject to tax under equitable tax principles. Deductions are matters of legislative grace, and the burden of clearly showing the right to a claim deduction is on the taxpayer. The tax benefit rule applies to require inclusion of income when events fundamentally inconsistent with an earlier deduction occur. Here, WDC claimed California source deductions related to its beverage distribution rights on originally filed returns. Were WDC not engaged in a unitary trade or business, the originally filed business character of WDC's assets would be inconsistent, and the tax benefit rule would require recovery of those amounts. However, as previously noted, it's the appellant's burden to prove, by cogent evidence, rebutting their own binding admission of unity, and to establish error in the FTB's determination of unity. As the foregoing facts demonstrate that unity existed, appellants have not met their burden. As a unitary trade or business existed in the year at issue, and the assets sold were business assets of that unitary trade or business, California Supreme Court and appellate court cases, such as Host Celanese versus California or versus Franchise Tax Board, and Jim Beam versus Franchise Tax Board, require characterization of that sale as business income. Moreover, the duty of consistency would apply to require business treatment of appellant's sales. The duty of consistency precludes a taxpayer from gaining an advantage in one year, then claiming an incompatible position to disadvantage the taxing agency in another. The duty of consistency specifically applies if a taxpayer makes a representation on which the FTB relies and then seeks to recharacterize the situation in a way that harms the FTB. For the years prior to 2010, WDC represented that its unitary trade or business encompassed the distribution rights which WDC characterized as business assets. WDC amortized those rights in closed years, generating business losses, then sought to recharacterize the assets to the FTB's detriment as non-business assets in the year at issue. Accordingly, the duty of consistency applies, requiring treatment of the previously reported assets as business assets of the unitary trade or business in the year at issue. As WDC's operations constituted a unitary trade or business, and beer distribution rights and related assets were assets of that unitary trade or business, WDC is required to apportion that business income using the standard UDITPA apportionment formula. Next slide, please. The trucking regulation, inclusive of the substantial and occasional sale rule, constituted WDC's standard formula for 2010. In the appeal of Fluor, the State Board of Equalization held that when conditions of regulations promulgated under Revenue and Taxation Code, or RNTC, Section 25137 are met, those regulations become the standard apportionment formula without the need to show distortion by either party. Next slide, please. The FTB's exhibits prove, and WDC EO has testified, that WDC was a registered common carrier with the Department of Transportation, carrying tangible personal property of others for compensation. CCR Section 25137-11, Subdivision B1 defines a trucking company as, and I quote, a motor common carrier, a motor contract carrier, or an express carrier which primarily transports tangible personal property of others by motor vehicle for compensation, end quote. As WDC was a trucking company under this definition, CCR Section 25137-11 applies to apportion WDC's income. Appellants claim that CCR Section 25137-11 creates a de facto separate trader business. As evidence, the appellants note that Subdivision A1 of the regulation requires trucking companies identify business and non-business income, which appellants assert requires bifurcating trucking activities from other activities and applying the regulation solely to the trucking activities. However, reading the regulation in its entirety remedies this misapprehension. Subdivision C of the regulation provides that a trucking company's income shall be apportioned using the property, payroll, and sales factor rules at RNTC sections 25.129 through 25.136, unless modified by the trucking regulation or other regulations promulgated under 25.137. As the trucking regulation only modifies a trucking company's sales from hauling freight, mail, and express, and property and payroll related to mobile property, all other sales would follow the standard apportionment rules. There would be no need for this provision if, as the taxpayer suggests, the regulation only applied to the enumerated trucking activities. As trucking income clearly encompasses business income beyond trucking operations, the regulation's requirement that income be characterized as either business or non-business is a common feature of formulary apportionment, rather than a delineation of a separate trucking tax base. CCR Section 25137-11 does not require that WDC treat its transportation division as a separate apportionable trucking trader business. Rather, it requires that WDC source its qualifying trucking activities pursuant to the regulation. It should be noted that other special apportionment rules under 25137 provide for modification of the apportionment of sales, property, or payroll, and these provisions likewise do not require separate apportionment. Next slide, please. Furthermore, the unitary business principle mandates that the income at issue not be separately apportioned. Under the unitary method, unitary business income is derived from the functioning of the unitary business as a whole. Accordingly, the income of the unitary group is combined, along with that group's apportionment factors, to ensure the group's unitary income is apportioned based on the activities of the entire unitary business. Appellants' arguments would undermine these basic concepts of unity, which provide that once a unitary relationship is established, the unitary elements are not severable and contribute to the unitary business as a whole. Furthermore, were the OTA to accept appellants' claims that trucking activities must be separately apportioned under the rules set forth in Section 25137-11, it would overturn long-standing law and create significant upheaval. Because WDC was a trucking company, it was required to use the sales factor provided at RNTC sections 25134 to 25136 and the underlying regulations, unless modified by a special regulation. CCR section 25137, subdivision C1A, provides that substantial and occasional sales, to include taxpayers' distribution rights, should be eliminated from the sales factor if, in the aggregate, those sales to a single purchaser are outside the taxpayer's normal course of business and result in a 5% or greater decrease in the sales factor denominator. As WDC's Miller and High Country asset sales both constituted a greater than 5% decrease in the sales factor denominator when excluded and were not occasional, the substantial and occasional rule applied and became the standard UDIPA formula for WDC, giving rise to the FTB's assessment and WDC's tax liability for the year at issue. In addition to WDC's liability, pursuant to UDIPA, WDC's non-resident shareholders must source their pro rata share of WDC's income pursuant to the standard UDIPA formula, and S Corporation's non-resident shareholders are taxed only on their California source income. CCR section 17951-4, subdivision F, provides that a non-resident shareholder's pro rata share of income of an S corporation conducting a unitary trader business within and without California shall be determined as if the S corporation were a partnership. The total business income of the partnership is apportioned at the partnership level in accordance with the apportionment rules of UDITPA and distributed to the partners, giving rise to the liability of the partners. In this case, that applies to WDC's shareholders. They are taxed on their apportioned piece, or excuse me, on their distributive share of the apportioned UDITPA non-resident shareholder income. Next slide, please. Now that we've established that the standard treatment results in liability for WDC and its shareholders, we turn to appellant's final alternative argument. Formulary apportionment provides a constitutionally sufficient estimate of business income attributable to California. The party seeking alternative apportionment, pursuant to RNTC Section 25137, must demonstrate, by clear and convincing evidence, that the standard apportionment formula does not fairly reflect the taxpayer's business in California. Further, the mere assertion that there's a better approach to formulary apportionment is not sufficient. In the context of the substantial and occasional sale rule, a taxpayer's deviation from the standard formula requires a showing, by clear and convincing evidence, that application of the regulation unfairly represents the extent of the taxpayer's California business activities, and that the taxpayer's alternative is reasonable. As WDC is the party seeking alternative apportionment, it bears this burden of proof. Application of the substantial and occasional sale rule to WDC removes WDC's presumptively distorted sales from the sales factor. Next slide, please. When CCR Section 25137, subdivision C1A, was expanded to include the sale of intangibles, the following rationale for the substantial and occasional sale rule was provided in Legal Ruling 1997-1, and I quote, "The exclusion from the sales factor, pursuant to 18 CCR Section 25137 C1A, of substantial amounts of gross receipts from an incidental or occasional sale of a fixed asset is based on the rationale that such gross receipts do not fairly reflect the taxpayer's day-to-day business activities, and therefore cause excessive income to be apportioned to the state where the occasional sale took place. This is especially so if the growth of built-in appreciation occurs over a substantial period of time, because the taking into gross receipts in the year of recognition event does not reflect the gradual effects of appreciation over several years. This same rationale can be applied to the gross receipts from incidental or occasional sales of intangible property, held or used in the regular course of the taxpayer's trade or business." End quote. Next slide, please. The purpose of the sales factor is to reflect the market for the taxpayer's goods and services. Thus, the key purpose for this rule is to prevent the substantial and occasional sales from distorting the apportionment of income derived from day-to-day or ordinary business activities. Because the substantial and occasional sale would overload the sales factor, distorting the reflection of the market for the taxpayer's goods and services, the regulation uses the ordinary activities of the taxpayer's unitary trader business to source such sales. Another reason the sales are excluded in this case is that the recognition event doesn't reflect the gradual effects of appreciation over multiple years. Appellants argue that WDC's 2010 self-reported unitary business activities cannot fairly represent WDC's sale of its assets, citing to Tenneco. Tenneco involved the apportionment of installment sale income. In Tenneco, the FTB asserted that an installment sale should use the apportionment formula of the year of the original sale to source later year installments. The appellate court agreed with the FTB, providing that an apportionment formula based upon the factors of the year of sale more closely reflects the activities which gave rise to the income. Appellants in this case correctly identify the issue, highlighted in Legal Ruling 1997-1, that the activities giving rise to the gain on WDC's distribution rights and related assets do not correspond to the year when the recognition occurred. However, it's precisely because of this presumptive distortion and the inability to identify activities of a single prior period relating to the gain on the assets that the substantial and occasional sale rule exists to apportion such gains. In this case, WDC derived business income from the sale of unitary business assets in 2010. Pursuant to the substantial and occasional sale rule, The FTB used WDC's day-to-day business activities to determine the degree of WDC's sale that constituted California source business income. The rationale inherent in the regulation is more than justified in this case. Appreciation of WDC's distribution rights occurred over years of ownership. Most of the rights were put into service more than a decade prior to the sale. To complicate matters, WDC amortized those distribution rights in previous years, thereby reducing the California basis and increasing the gain which WDC recognized at the time of sale. As the unitary business activities which generated the gain cannot be isolated or clearly identified, using the day-to-day business operations of the unitary trader business to apportion the income is appropriate. Furthermore, this rationale as applied to the facts affirms rather than undermines the purpose of the substantial and occasional sale rule, which is to ensure the day-to-day or ordinary business activities and the taxpayer's market are fairly reflected. Inclusion of the receipts at issue would undermine that purpose. As appellants have failed to establish that the standard apportionment formula unfairly represents WDC's business activities by clear and convincing evidence, they're not entitled to alternative apportionment. Additionally, appellant's alternative formula is not reasonable. Appellants argue that an alternative formula consisting of 5 business days in January represents the years of activities which gave rise to the appreciation on the beer distribution rights. This alternative posits, without evidence, that a 10-day period is representative of all activities giving rise to the gain on WDC's distribution rights. Appellant's argument does not establish why this approach is rational, much less reasonable. As yet another alternative in this Russian nesting doll of alternative arguments, appellants claim they would accept an alternative of blended prior year apportionment should the FTB so provide. As WDC is the party seeking alternative apportionment, it is required to prove that the standard apportionment formula unfairly represents its California business activities and that its alternative is reasonable. It's failed to do so. As WDC's unitary income constituted business income of a unitary trader business, and appellants have not established unfair representation by the standard formula or a reasonable alternative, the FTB's assessment of the appellant's tax liability should stand. Next slide. In addition to the liabilities at issue, appellants also dispute the penalties and interest. We've already established that WDC was an S corporation engaged in a unitary trader business within and without California, and that WDC's sale of business assets constituted apportionable business income, resulting in a liability for WDC and its non-resident shareholders. Each taxpayer has a non-delegable obligation to file a tax return by the due date. Despite an April 15, 2011 due date, WDC's non-resident shareholders did not file 2010 tax returns. RNTC Section 19131 provides that the FTB shall impose a delinquent filing penalty, specified as 5% of the tax due for each month that a valid tax return is not filed after its due, not to exceed 25% of the tax. In this case, where a taxpayer fails to file a tax return at all more than a decade after its due, the full penalty is applied unless the taxpayer can establish that the late filing was due to reasonable cause and was not due to willful neglect. While the penalty may be abated upon a showing of reasonable cause, it's the taxpayer's burden to prove that reasonable cause existed. To establish reasonable cause, the taxpayer must show that the failure to file occurred despite the exercise of ordinary business care or prudence that an ordinarily intelligent, prudent business person would have acted under the same fashion in the same circumstances. Specifically, in cases like this, where the taxpayer is asserting that it relied upon a professional substantive interpretation of law that the filing was not required, the precedential OTA opinion of Appeal of Summit Hosting LLC provides that the taxpayer must show, first, that the person relied on by the taxpayer is a tax professional with competency in the subject tax law, and second, that the tax professional's advice is based on the taxpayer's full disclosure of all the relevant facts and documents. Appellants bear this burden of proof, and taxpayers' failure to introduce evidence that is within his or her control gives rise to the presumption that the evidence, if provided, would be unfavorable to the taxpayer's position. Individual appellants have provided no evidence regarding whom the non-resident shareholders consulted regarding their tax liability, and as the identity of these professionals is unknown, there can be no appraisal of that professional's competency in California tax law. Moreover, the reliance on WDC's preparer, who reported non-business income and gross receipts in the same transaction seriously undermines that tax professional's credibility and professional standing for California tax law. As unsupported assertions are insufficient to satisfy a taxpayer's burden of proof, the penalties against appellants in this case should be sustained. Finally, Revenue and Taxation Code Section 19101 provides that interest must be paid on appellants' balances, with such interest compounded daily. Taxpayers claim that they're entitled to abatement under RNTC Section 19104, asserting unreasonable error or delay caused by managerial or ministerial acts. Appellants bear the burden of proof, and review on this issue is limited to abuse of discretion. As stated in its briefing, the FTB is prepared to abate interest from December 2nd, 2016 through November 3rd, 2017 due to unreasonable managerial delay. Evaluation of taxpayers' claims, to include the appellant's protest, appellant's settlement request, and various other issues, required careful deliberation and arrived at the proper conclusion. Proper deliberation regarding regulatory application and management activities, such as replacing a hearing officer, is not an error due to managerial or ministerial act. As WDC's unitary income constituted business income of a unitary trader business, and appellants have not established unfair representation by the standard apportionment formula or a reasonable alternative, WDC and WDC's non-resident shareholders' liability is reflected in the FTB's assessment and should be sustained. Moreover, as the appellants have not shown reasonable cause for late filing or proved abuse of discretion in interest abatement, those claims should likewise be denied. I'm happy to answer any questions the panel may have at this point.
Thank you, Mr. Havens. I'm going to go to the panel and see if there are any questions regarding your oral arguments today, starting with Judge Johnson.
Thank you. No questions at this time, though.
Thank you. Judge Long?
Yes, I do have 2 questions. First, I want to go back to the tax benefit rule, and I want to ask in appellant's reply brief and also in their argument today, they asserted that FTB has the burden of proof on that issue, and I want to know if Franchise Tax Board has a position or a response to that assertion.
Yes, Judge. The Franchise Tax Board would bear the burden of proof on that particular issue. However, in order to arrive at that issue, finding that the taxpayer was not unitary would be required.
All right, thank you. And my next question is about the penalty abatement. And I just want to clarify, because this is a little bit complicated, because my understanding is that the penalty is applied on the individuals, not the entity, and that there's been testimony about seeking preparer advice at the entity level. Is it FTB's position that in order to get penalty abatement for Reliance and a preparer, that the individual taxpayers would have needed to seek advice?
So, Judge, in this particular case, because the individual taxpayers bear the burden, or excuse me, are required to file a return, and the individual tax, the individuals are required to do that regardless of personal knowledge. Reliance upon the preparer would be something that they would need to prove individually.
All right, thank you. That's all my questions.
Okay, I have no questions. I appreciate your presentation. We're doing pretty good on time, so I'm going to go ahead and move to Mr. Antolin for your rebuttal.
Thank you.
Thank
Just
you.
A handful of points. So first, Judge Long, you had asked about the Boggs Declaration. It's paragraph 14, where Mr. Boggs had stated that the checks had the printed name of each division on them, and that blank checks were also in the possession of the divisions should they need to write a check. Turning to the FTB's argument. First, the U.S. Supreme Court has made very clear that the linchpin of apportionability is the unitary business principle. That is what is the condition for the state of California to tax a portion of this gain. The tax returns what was said on the tax returns, none of that is dispositive. What is dispositive is whether or not there is a unitary business. In our view, the evidence is overwhelming that there was not sufficient connection between the beverage distribution business and the transportation business to create a single unitary business. One point that counsel for FTB had mentioned is that the presence of the single checking account made intercompany financing unnecessary in this case. There's no evidence that any division needed financing or intercompany financing except for the beverage distribution business, which obtained its own line of credit. The assumption that there could have been other intercompany financing that had been avoided in this case, there's no evidence to support that. That's pure speculation. The consent decree related to the EEOC matter occurred in 2025, 15 years after the years at issue. It has no relevance here. Citation to Exxon as supporting the view that a unitary business can be found even though there are arm's length transactions really misses the substance of that case, which was a completely unified, vertically integrated oil company, which we do not have in this case. On the Regulation 25-137-11 trucking regulation, we differ with the FTB's interpretation of its regulation. In our view, the FTB is, in effect, asking this panel to expand the scope of that trucking regulation to include trucking companies and non-trucking companies. But that is not what that regulation says. In order to expand the scope of that regulation, the FTB would need to go through a regulation project to do that. It has not addressed it. Maybe they would come out that way if they addressed it, but they cannot do it ad hoc through this appeal. Finally, on that point related to the application of the trucking regulation, counsel for FTB mentioned that under subsection C of that regulation, there is language there that suggests it would include non-trucking companies. We disagree with that. Our reading of subsection C, and what it says is that you go to regular UDITPA, not the special trucking company UDITPA, when a trucking company has non-mobile property. Then you apply the principles in regular UDITPA. When you have a trucking company with mobile property, then you apply the special rules in section 25-137-11. That is the reason for that distinction. To read that distinction in the way that the FTB suggests here would broaden it to apply to non-trucking companies, which then creates a conflict internally within that regulation between subdivision A and subdivision C. The panel should avoid reading the regulation in a way that creates internal conflict. As to the distortion under 25-137 generally, this is interesting. So here, the FTB agrees that the standard apportionment formula is distortive. The FTB says it is distortive to include in the denominator the receipts from the sale of the distribution rights, and therefore we have to modify the standard apportionment formula as set forth in Regulation 25-137C to remove that those amounts of gross receipts. And the reasoning is, well, it was a sale of an asset. If you remove the receipts of the sale of the asset, then you are reflecting apportionment not skewed by those large amounts of receipts. You are apportioning that income by, quote, the day-to-day, regular business operations. Let's accept that premise for a second. What we are saying is, well, you should apportion if this is all apportionable income, you should apportion it by the regular day-to-day activities of the alleged unitary business, which would include the activities of the distribution business and the trucking business. But when you apply that to 2010, we don't have the distribution business. The business was sold on January 11. There's no room in that year to properly reflect the day-to-day activities of the distribution business. That is distortion as well. We're not looking at the true day-to-day operations of the, quote, unitary business. We are looking at really a skewed version of that business, which is heavily dependent on just the transportation division and excludes the operations from the beverage distribution business. So there are ways to fix that. We have offered two what we believe are reasonable alternatives, and we ask you to take a look at that. Finally, on the penalty issue, the returns were prepared by, the return for the corporation was prepared by a very well-respected Colorado accounting firm, Earhart, Keefe, Steiner, and Hotman, PC. It was reasonable for the corporation to rely on that accounting firm to prepare its federal and state tax returns. And in preparing those federal and state tax returns, that accounting firm also had to prepare K-1s for the shareholders. And on those K-1s, that accounting firm had to make a determination of what income, if any, is sourced to California. And it was reasonable then for the corporation to rely on that determination made by that accounting firm. It follows then that when the shareholders, none of whom are California residents and none of whom are tax professionals, when those shareholders receive the K-1 from the corporation, it is reasonable for them to rely on the determination of whether there is California source or not California source on those K-1s. They do not have to, and it would not be reasonable to expect them to hire separate tax professionals to evaluate the sourcing information on the K-1 provided by the corporation. That is not required under Boyle, under the law. No further comments.
Thank you. I'm going to see if there are any further questions from the panel, starting with Judge Johnson. Any questions?
I think all my questions have been answered. Thank you.
Thank you. Judge Long, any questions?
I have no further questions. Thank you for your presentations.
Okay, I have one question, just to clarify. So mine is about the tax reporting. Western Distributing Company did not report any separate unitary businesses, but included Western Beverages deductions in the calculation for the unitary business income. So my understanding, and Franchise Tax Board can correct me if I'm wrong, is arguing that these representations indicate that Western Beverage was a part of the unitary business. So can you clarify your arguments on the tax reporting point for me?
Yes, our position on the tax return is that the returns are not correct on that point. When we looked at the actual facts after the audit had been completed, we determined that they should actually not have been reporting as a unitary business. The facts do not support that conclusion.
Okay, great. Thank you. I don't have any other questions. since we did ask a few, I can go ahead and see if Franchise Tax Boards has any comments, and then we'll go back to the appellants for final statements. Thank you.
So Judge, we do just have a couple of quick comments. Regarding the standard apportionment formula, the substantial and occasional sales rule is the standard apportionment formula. It's not a rationale, it's not a justification, it's the formula. We have provided some history as to why it is the way it is, but it's still the taxpayer's burden to prove that that formula is incorrect or is unfairly representing its business activities. And one final note, during testimony yesterday, we had asked the CEO whether or not beverage operations continued following the sale of the beer distribution rights. He testified that they had. Thus, taxpayers' claims or appellants' claims that the unitary business was somehow fundamentally altered bears closer scrutiny. The beverage operations continued following the sale of beer distribution rights, as did the trucking operations. So thus, the daily business activities during the year of sale included all operations. Katie, did you have any? Those are the total of our comments. Thank you.
Thank you. Back to Mr. Antolin. Any final statements before we close for the day?
Thank you. One quick response to the final point made by my colleague from the FTB, and that is, it is true that the beverage distribution business did continue after the sale of the Miller and other beer distribution rights in 2010, but it continued in a very small and much more diminished capacity. It is essentially not the same business. And to suggest that the nature and the day-to-day operations and the factors, the sales, property, and payroll of the beverage distribution business did not change after the sale is completely incorrect. You can see that in the numbers and the dramatic change in the apportionment formula from 2010 versus the prior years. That's all, Your Honors.
Great, thank you. I think we're ready to conclude the hearing. The evidence has been admitted into the record, and we have the arguments in your briefs as well as the oral arguments presented today and the testimony provided this week. We now have a complete record from which to base our decision, and we're ready to submit the case today. So the record is now closed. The panel will meet and deliberate and decide the case. The party should expect our written opinion no later than 100 days from today. With that, today's hearing is now concluded, and we are off the record. I want to thank everyone for your participation in this hearing and your time, effort, and energy in this matter. Thank you.